J. Cage, today speaking on behalf of Wealth Education. This is where equity starts, okay? So, I'm going down the road today on the subject is, what is a PPM? A PPM is a private placement memorandum, okay? What basically is, it's a document sent out to investors who is potential prospects that invest in the private market via securities, right? This is how startups with high risk and high rewards attract investors. Alternatively, established business and organizations use this form too. So we see that established business also use this model when they're trying to, get funded, issuing private equity and bonds and so forth and so on. And even the public market, well, this is the private market, sorry, before they go public, right? Or they might got companies that been around forever that just private hair that just need funding at certain times, Now, corporate and securities attorneys and investment bankers and consultant firms assist business owners with this to raise funding for different reasons. So the purpose of this is what reason we're raising funding. Different categories, different layers. First of all, the first funding start off be seed funding, right? After that, you got startup funding, right? Startup funding is based on working capital and expansion, growth. In that time you might go round 2, you got round 3, and each one got to show what this funding is going for. So we know big companies, main strategy behind the scene is acquisition. So they might be buying up other companies. You know what I'm saying? So, like I say, they could be getting it for any purpose. More marketing. You know what I'm saying? Expansion could be just, we trying to get our presence in more markets, more management, more, whatever it may be. So we're not just saying we want to raise all this money, but we don't know what we're raising it for. The purpose of this is to expand, for the future. So now it become a real profitable, company that could, compensate the employees, the in-house, owners, which I just say the employees, management, investors, and so forth and so on. Maybe got debt obligation. We just talking more on the equity side right now, because wealth education was based more on equity over debt. Not saying we overlook debt, but we want to focus more on equity because most of the time people that promote finance, they're just talking about debt, loans, which is cool, but this is a new breed to the area. You're not saying I'm the only one. I'm just one of the only guys that look like me that talks about it as I see, and a few other guys out there, John Paul and different guys of that nature. But anyway, so what this agreement does is it set out all the terms that you're looking for. Because remember, when we go to the bank and borrow money, the terms is set more they favor. Over here is negotiable. So you sitting out this form and you saying the type of interest you looking to pay, what type of relationship, not relationship, what type of long-term, short-term purpose you looking for, what you willing to give up, what you not willing to give. Just because people see that they're selling a high percentage of their company, it's also telling where a person may sell, just say 60% of their company, but they may be holding certain rights. They might also have themselves in a position where, all right, it's sold it, but I'm the first guy that get to buy my own stocks through this company also. So when you tell these agreements through these great securities attorneys or corporate attorneys, okay, they kind of know how to, sharpen the thing for you. You know what I'm saying? Now your investment bankers, they're someone that we've been seeing for, a long time. These guys, they underwrite the securities, which most time might be a stock, it could be a bond, and they got a pool of investors that they got individual contacts with, individual investors, group investors, institutional investors, and so forth. So they make that call over, and they say, okay, look, we got this great startup that we know is going somewhere, or established company, and then once this get underwrite and so often, so far, so on, they're gonna cash out because they just, it's like an insurance policy. They just underwrite the security, saying that we take initiative and then go wrong to a certain extent. So that's what you saw these big Wall Street banks were doing, even for the economy when so-called went like a bathtub, overflowed and went out. You got great consultant firms. I spoke with one, what I'm saying, forgot the name, it was over on the West Coast, because my thing is getting in with, because I understand I ain't just trying to jump into venture capitalists, but the thing is I understand that you got consultant firm that got different intel and different inside relationships with these different venture capitalists or different investors of that nature. So, it's best to hire a consultant firm sometime too, because they know, they consult all these other people, and they got venture capitalist consultant firm. And I learned, like, everything you're trying to do is a consultant that's fun. So with this being said, this is one of your first agreements, one of your first investment package that you need to be putting together, trying to figure out, what are you looking for, what are you not looking for, and then be willing to, take some time out, because this is not just an overnight thing. That's why debt finance are more easy, because you got a good credit, great business credit score, paybacks, and different things of that nature. You go get you $200,000-$300,000 in funding, $1 million, whatever. You get your line of credit for $2 million and things like that. And we working that also, right? But I'm more hip on this side. And like I say, the only thing I found, to me personally, that was better than the equity financing, and I learned it years ago, but didn't know the indebtedness, is the insurance policy. So you gotta have the insurance policy fundamental, because anything dealing with debt obligation, they can always take their money back from you. Even investors, they could even have a rescission of different, things that, want to pull out, that they might be locked in for the next 2-3 years. It's a pity they pull out their money, but they can always, but when you got your insurance policy, it's hard for insurance company to take back something that's already really yours. So that's really the foundation to the in-house banking and the private banking sector. But just having that, and also moving on this side, the private, and then you got your public debt. You know what I'm saying? You might be, monetizing for certain reasons, but over here it's more just like you got startups, and like me, I know no matter how much unlimited money I got access to, I always need investors for different purposes, because they got more resources than we may have, different things of that nature. It's just a lot. So with that being said, when I start understanding this and start overstanding, was looking for how to issue my own shares to investors, like I told you on one of my other videos, I went crazy because I started understanding better than from the perspective of people just talking about public stock trade. I'm trying to teach you how to issue your own securities. And I could even go down the road, we talking about this private placement memorandum is also issued through bonds. So we know with bonds, it might be so many bonds that you issuing, right? I think it run like 1,000 at a time versus, can't remember the details on the bonds because I don't really keep up with too many bonds. But bonds are a great issuing too for startup funding too, because it's a debit. It falls on the debt side, but it's still a good look, you know what I'm saying? So that the bonds are really vital too, because you can issue both bonds and stock. And with that being said, this is how they actually, in most cases, not all cases, but in most cases, when somebody are trying to sell company bonds or stocks, in most cases, they start with a private placement memorandum. After they got their company, it's structured and different things, and they got the valuation tailored, and they got, they management established, and, different things like people gonna be a part of it. This way they're going into the private placement memorandum, and it's other agreements that come in it, but this is just the overall of what's going on behind the scenes. When you see these startups, like I always tell you, in public magazines that's saying that this company was a startup, it got 1.5 million or maybe 10 million. I saw some get, not exaggerating, putting the 8 on the 2, 92 million for a startup company, but they working for Google, started their own self-driving car, but not for people, but for to get commodities around. They went from getting 92 million, then they got 800 some million. So these crazy startups are getting all this money while we're sitting around playing with microfinance and getting happy about $50,000, a couple of $100,000, and behind the scene, these people are getting all this money for the greater the good, to expand the next generation, expand the economy, expand the planet, whatever it may be. We're not just taking this money just to say we got it. We have a great in-depth plan, to build our trade now, the operation, to have more of us that's actually going to invest into the next generation of you. So somebody that's 10 or 15, 20 years old that need funded, me and my circle should be able to, here go $2 million on a non-cultivated share where you don't have to pay this back for the next 3 years, because it's a growth stock for us. And get yourself together, youngin. You to find out this beautiful tech, because I'm more into tech than just traditional businesses, me, myself, personally. So this is why I work hard at, having an in-house structure, and then we dominate it out and we keep expanding, you know what I'm saying? New world takeover, baby. And with that being said, we own something. Again, what is a private placement memorandum? Too much power for the ears, too much for the imagination if I really go into what I really know. But like I said, quadrillions of dollars that's waiting on you whenever you wake up, man. Get out the microfinance sector. It's cool to use it, temporary. We can't be 5 years later still talking about all these micro strategies we using to just expand our credit from trade lines and all that. We got to be able to expand. So once 5 years come back, we need to be all the way where we need to be at, man. Later. I'm out.